Facebook Live. Here we are again, Investors Edge Real Estate Group. What's up, everybody? It's Cashflow Kris here, and I just wanted to go over today's news, kind of talk about what's going on, keep all you guys current with our events, because I know a lot of people like to put their head in the sand and not pay attention in down markets, but this is exactly when you need to be paying attention. So let's talk about today. We're down again. The stock market went down 500 points to start out. Right now, we're averaging at about a negative over 200 for the day. Hey, Nikolai, Joni, Mark, thanks for joining, everybody. Appreciate it. So let's have a look at what is going on. So this year, like I said, we're down about 200 points today. As of 10 a.m. Eastern time, we were at 23,805 for the Dow Jones. So our high, as you can see, was 26,616. We're down almost 3,000 points for the year, and that's 10.56% year to date. So I've been guesstimating. Obviously, I don't know. Nobody knows what's actually going to happen, but we're definitely due for a down market. So I'm estimating a 10% negative year, but we're already there. So it couldn't get much worse. It might get better, but it could also get much worse. Hey, Cameron Jones, Michael Penrod, Lucy Lopez, thanks for joining, everybody. I appreciate you watching. So this is where we are today. So let's go back in history, though. I want to talk a little bit of history with you guys. This is a little bit of a small diagram. I need to make a bigger one. But that is the stock market since about 2000. So let's break it down here, what we have. So back here in 1999 is when we had the stock tech bubble. I'm sure you guys remember that. The market was doing great. It was up to 11,346, and then a bunch of a bunch of tech companies went under. They were way overvalued, which that sounds a lot like today. Amazon is valued at crazy numbers, and they don't even turn a profit. And it took a slide. It took a while, a couple years, but it took a slide down to 79.20. So over that time, 30% negative was the stock market. And of course, remember, your financial advisor told you just to hold it out and wait. You know, this is a long-term play. Just wait it out. Well, you waited 3 years, 2 to 3 years, and you lost 30%. Congratulations. So now it got built up. It went all the way up to 13,667 in 2007. We all remember those days, right? That wasn't too long ago. So the real estate was up. It was insane. The stock market was up. Everything was going nuts. And then we had an insane downfall. Now, this one was pretty big. This is a lot bigger than an average one. But from September 07 to only March of 09, less than 2 years for this historic tumble to happen, the stock market went down 46%. So if your investments were tied directly to the stock market, you lost half of your net worth in 2 years. This is insanity, which is what we're going to talk about. What is insanity? Let's look at the definition. Insanity is doing the same thing over and over and expecting a different result. So you listen to your financial advisor and they told you stock market, invest in those mutual funds long term, right? Don't worry about a down market. You just ride it out. Ride it until you're ready to get out, right? Well, doing that made you lose 30% and then 46%. So even simply having your money on the sideline would have been way smarter than listening to your financial advisor and just waiting it out. Paying attention is what is a great way to keep from taking huge losses. That's what I'm saying. Get your head out of the sand. We may not have a crazy down market, but again, we're already down 10%. So insanity, doing the same thing over and over again and expecting a different result. If it went up and crashed, went up and crashed, went up and crashed, guess what's going to happen? It's going to go up and crash. All right. So that is the definition of insanity. So like the title said, I'm going to take you on a little tale today. I'm going to take you on a tale of $1 million. There's two different ways to do this. There's traditional investing, so you're going to keep it in the stock market and see what happens, ride till you die, right? And then there's the real estate way. So I'm going to show you these two different ways and tell me which one you think is better. All right, a tale of $1 million. So let's just say you worked your whole life and you have $1 million in savings right now, in mutual funds, retirement, 401, whatever. You have $1 million to your name. 2018, so you're at $1 million. And so if you get into the stock market, I assume you're going to lose 10%. All right, so that's going to bring you down to 900,000. But let's talk about what happens if you invest in real estate. So as you can see, one of the great benefits of real estate is that you can leverage. So with your 1 million, it's just going to sit there. If it goes up in value, you make money. If it goes down in value, you lose money. But in real estate, you can leverage. So you can take that same $1 million and you can leverage that into a $4 million multifamily investment, which are everywhere. We buy them all the time. So if you can net 6% cash flow, 6% on your total investment, which is, again, extremely possible. You're going to have, so this would be simply making an 11% return with 6% going back to, with 5% going back to your loan. Well, again, very doable. So that $4 million asset, so you've turned your asset from $1 million to $4 million. That's going to kick off $240,000 a year in passive income. So again, negative 100,000 or positive 240,000. And then the second thing to think about is your asset is now 4 million, not 1 million. So let's just take a really low appreciation rate of 3%. It may be more, maybe less, but 3% is a very low but steady appreciation rate. Well, your $4 million appreciating at 3% is going to be another $120,000 in appreciation and equity. You can't do a lot with that. It's simply equity, but you do have, that's the only way to make money in the stock market. So let's see what it looks like. So at 2019, at the end of the year, your 1 million is down to 900,000. Now we know the stock market's already down 10%. So if you started this year with 1 million, you're already down to 900,000, unfortunately. So that's where you're really going to want to start to think, right? So you're, but in real estate, you are at 1.24. You have your $1 million invested, and then you've made $240,000 and an extra $120,000 in equity buildup. Okay, so let's just say the market rebounds, and next year, 2019, it goes up 6%. Well, now you're going to be at 954,000. Your apartment, on the other hand, is still going to make another 240,000. So now you've made $480,000 in 2 years. You've made $240,000 in equity, which isn't really too important. We don't worry about that. So you're at a net of 720,000, opposed to the stock market, a negative 46,000. And that's if it goes back up next year, which I don't think it will. I think we're in for a couple of years because we've been on an uptrend for way too long. So history always repeats itself. And when we're way overdue like that is when we have major corrections. We didn't have enough minor corrections over the last 10 years. And so now a major one is set to take place. Like I said in a post earlier, if rumors of a trade war take our stock market down 2, 3, 4% a day, what is an actual trade war going to do? So real estate is a much safer investment. And so I urge you to, learn more about it. Possibly pull your money out, self-direct it if it's in a retirement account, and transfer your assets. Even in a down market, having your money simply on the sidelines is a better strategy than the buy, hold, and pray that most financial advisors tell you to do. And I couldn't disagree more. So if you want to learn more about real estate investing, join me tomorrow. Tomorrow I have a free webinar. I'll put a post in the comments, and so you can sign up. It's a free webinar, and what we're going to be talking about is just the basics. Real estate investing 101. What are the benefits of real estate investing? how do you get into real estate investing? You know, what are some of the requirements? So again, it's going to be a basic class. I hope will be something for everybody to learn. I'll put the link in the comments, and I hope a lot of you guys sign up. I hope this was valuable. If you found value in this, please share it, forward it, and please comment, because I want to know your guys' ideas and what do you think is going to happen in the next year. So please leave your comments below, share and like. Talk to you guys next time.